It's a recurring nightmare for retail traders. You spot a perfect breakout, execute the trade, and watch the price immediately reverse to trigger your stop loss. Institutional traders orchestrate these sudden reversals to harvest the liquidity required to fill their massive positions. These zones are buy-side and sell-side liquidity. Buy-side liquidity, or BSL, is the cluster of buy orders sitting above a resistance level, while sell-side liquidity, or SSL, is the pool of sell orders resting below support. Giant firms cannot enter a position without moving the market against themselves. By pushing the price into a cluster of retail stop losses, they generate the massive counterparty volume they need to fill an oversized order at a stable price. This maneuver creates a liquidity sweep. Smart money intentionally triggers those stops, creates a temporary illusion of momentum, and then pulls the price back in the opposite direction. This false breakout lures retail traders into buying at the absolute peak of a market cycle, right before the institutional sellers take control. These obvious stop losses serve as the exact fuel institutional predators use to safely enter or exit the market. Modern market liquidity is maintained by high-frequency trading, or HFT, algorithms, and specialized market makers. HFT refers to automated systems that use complex algorithms to execute thousands of trades per second. In stable conditions, these machines profit by capturing the microscopic bid-ask spread, the tiny difference between the highest price a buyer will pay and the lowest price a seller will accept. These systems are programmed to prioritize risk management above all else. When price volatility spikes beyond a specific threshold, these algorithms are coded to instantly cancel their orders and step away. This creates a liquidity gap, a chasm in the order book where no participants are willing to trade. With no buyers or sellers at the intermediate levels, the price must travel a great distance to find the next available counterparty. The events of May 6, 2010, provide the most extreme historical evidence of how these voids can shatter a market. The day began with global anxiety over a potential Greek sovereign debt default. As protesters filled the streets of Athens, a massive algorithmic sell order for index futures hit a market that was already deeply unsettled. As the sell pressure mounted, HFT algorithms across the industry detected the deteriorating market quality and simultaneously withdrew their liquidity from the order book. With no buyers left to absorb the momentum, prices teleported downward in a violent red cliff drop. Trades executed through a vacuum, causing the Dow Jones Industrial Average to lose nearly 1,000 points in minutes. While the machines stood by in cold standby mode, human traders on the floor erupted in a visceral panic, witnessing the total breakdown of orderly price discovery. When institutional funding stops flowing, market liquidity vanishes, turning a routine trading day into a destructive algorithmic trap. Surviving these engineered voids requires a shift in perspective. You must learn to recognize the visual signature of a liquidity hunt before the trap is fully sprung. The signature is a long wick piercing resistance, then aggressively closing back inside the range. This wick is the exact moment market makers absorb retail stop losses, confirmed by a massive volume spike. Breaking the opposite structural level confirms the trap, proving the initial spike was just to source liquidity. The fundamental defense is simple. Avoid placing stop losses exactly at textbook swing highs or lows. Orders clustered at obvious technical levels act as a beacon for algorithmic hunting programs looking for their next fill. To survive modern markets, you must look past the patterns taught in retail books and start identifying the liquidity pools the predators need to survive.